So in Oakland today, you've got two billionaires arguing in a federal courtroom over the rights to an intelligence that doesn't actually exist yet.
Right.
Meanwhile, half a world away, an oil tanker stuck in a geopolitical choke point is essentially dictating what the Federal Reserve will do in, like, 3 hours. Welcome to NovaStream.
It's a wild day.
It really is. We are your 24/7 home for live crypto markets, global financial indices, and auto-curated breaking news. Normally, we're tracking every tick of the tape, but today is Wednesday, April 29th, 2026, and the sheer volume of history happening at this very second is just staggering.
Yeah, absolutely staggering.
So we're shifting gears today to bring you the highlights of the day.
I mean, it really is a remarkable convergence. We're looking at a massive macroeconomic pressure cooker,
Yeah.
a clash of titans in the tech space, and crypto markets hanging entirely on the edge of a knife.
Yeah, and our mission today is to take that massive stack of flashing headlines and synthesize it into something that actually makes sense for you. We've pulled together the critical macro readings, the live courtroom dispatches, our live crypto sparkline charts, and even some consumer earnings.
Which is a nice change of pace.
Right, because whether you are actively managing a portfolio, or maybe you're holding a spot bag of XRP, or just trying to figure out how artificial intelligence is going to change your industry, the events colliding today are going to impact your wallet and your world.
And the connectivity between all of these seemingly isolated events, I mean, that's what makes today so critical. You see that clearly when you look at the global indices right now.
They're just flashing red and green across the board.
They're trying to digest a dozen different data points.
Yeah.
But the biggest driver of the entire global market today isn't a tech company, and it's not a major bank.
No, it's a geographical choke point. Looking at the commodities board, oil futures have just topped $115 a barrel.
Which is huge.
We are nearing the same highs we saw in the early days of the Iran war. And it all comes down to an ongoing impasse, where oil tankers simply cannot get through the Strait of Hormuz.
Right.
Help me understand the deeper mechanics here, because, I mean, this is about way more than just the price of a gallon of gas today, right?
Oh, absolutely. It is about structural shifts in the global supply chain. When a localized geopolitical choke point gets blocked, shipping companies don't just wait around.
They can't afford to.
Right. They reroute entire fleets around continents. That adds weeks to transit times and massive insurance premiums to every single container.
Wow.
So this war-driven energy spike is like this anchor weighing down the entire global economy because oil feeds into the cost of manufacturing, transporting, and selling literally everything.
So it just bakes inflation right into the cake.
Yeah, it is embedding inflation deep into the system. It's the primary reason core inflation is staying stubbornly near 3%.
Which complicates the picture immensely for the Federal Reserve.
To put it mildly.
Right. Today is FOMC day. The Federal Open Market Committee is meeting. But looking at the CME FedWatch tool, the market is priced in a 99% chance of a rate hold. A cut isn't even on the table. So if the actual rate decision is basically a non-event, what is the market actually holding its breath for?
The real event is the press conference that follows. And the subtext here is massive, you know? This is Jerome Powell's final FOMC meeting before Kevin Warsh takes over the Fed on May 15th.
Right, the changing of the guard.
Exactly. So the market isn't looking for a rate change today. It is desperately looking for forward guidance.
I was trying to conceptualize Powell's task today.
Yeah.
And, you know that old analogy of trying to land a plane in a hurricane?
Yeah, it doesn't quite fit here.
No. It feels more like Powell is steering a massive cargo ship. He has to pull the lever on rates today to address this oil-driven inflation, but the economic ship won't actually turn for another 6 months.
That's a great way to look at it.
He has to sound tough on inflation without signaling a panic that sends the broader market into a recessionary tailspin. But let me challenge the premise here for a second.
Okay, go ahead.
Do you think a higher for longer restrictive stance, stretching deep into late 2026, is already fully priced into these indices?
I would argue it isn't fully priced in at all. I mean, the market has priced in a hold for today, sure.
Right.
But human nature and market psychology, it still clings to this hope of rate cuts later this year.
They just want the cheap money back.
Yeah, they really do. So Powell has to navigate that lingering optimism while staring down a literal gauntlet of macroeconomic data dropping the rest of this week.
Oh, right. It's a busy week.
Very. Tomorrow we have interest rate decisions from the Bank of England and the European Central Bank.
Okay.
Then we get the U.S. data. We've got PCE inflation and jobless claims on Thursday, and the ISM manufacturing PMI on Friday.
Let's define the stakes on that PCE read because the consensus is sitting near 2.8%.
Right.
For anyone rusty on the acronyms, PCE is the Personal Consumption Expenditures Index. It's the Fed's preferred inflation gauge because it measures the changing prices of goods and services actually consumed by households.
Yeah, but it strips out the hyper-volatile stuff like food
Right.
and energy.
Right. So why is that one so critical this week?
Well, it is the crucial metric for that higher for longer narrative. A hot PCE read means that narrative becomes locked in reality, not just theory.
Hey, say.
But the real nuance actually lives in the jobless claims data.
Yeah.
If those claims come in high, say above 220,000, that indicates the labor market is actually softening.
And this is where we get into that bizarre bad news is good news paradox, right?
Exactly.
Because a weakening labor market is terrible for the average worker, but paradoxically, it might be great news for risk assets.
Yep.
Why? Because a cracking labor market forces the Fed's hand. It keeps the possibility of rate cuts on the table despite the inflation coming from the oil markets.
It is a massive macro tug of war between inflation data and employment data. And the most sensitive barometer for that tug of war is global liquidity.
Which brings us perfectly to our live crypto sparkline charts. Bitcoin is like the ultimate sponge for global liquidity.
It really is.
And right now, it is hovering around $77,800, just waiting for Powell to take the microphone.
The technical setup here is fascinating. On the daily chart, we have an immediate support floor at 76,000,
Okay.
with a much deeper demand zone between 73,000 and 74,000. On the upside, the first real resistance wall sits at 78,500.
Right.
But if we look at historical precedent heading into a Fed day, I mean, the setup is decidedly bearish.
Your classic sell the news dynamic.
Exactly.
After each of the last 6 FOMC meetings, Bitcoin has dropped anywhere from 6% to 30%. And the on-chain metrics we track are flashing some serious warning signs.
They really are.
The short-term holder cost basis is sitting at $80,100. Let's unpack the psychology of that number. Why does it matter so much?
Because it represents the average break-even point for anyone who bought Bitcoin recently. Human psychology dictates that the second a retail trader who has been sweating underwater for months finally sees their account hit break-even.
They just want out.
Right. Their overwhelming instinct is to hit the sell button to escape the stress. If the price pushes up to 80,100, 54% of recent buyers would suddenly be in profit.
Wow. Over half.
Yeah, and historically, that triggers a massive wave of distribution. We've already seen short-term holder realized profits spike to $4.4 million per hour today.
Meaning people are already taking chips off the table early.
Exactly.
But, I want to push back on this historical narrative for a second.
Sure.
I get the psychology of the retail trader, but the institutional landscape today is entirely different than it was during those last 6 FOMC meetings.
It has shifted, yes.
Look at the sheer firepower. U.S. spot Bitcoin ETFs just logged 8 straight days of inflows, totaling $2.1 billion. Total assets in these ETFs are sitting at $102 billion.
It's a massive number.
Doesn't this massive institutional footprint fundamentally rewire how Bitcoin reacts? I mean, we aren't just dealing with jittery day traders anymore.
I hear that argument constantly, but we really have to differentiate between structural inflows and short-term leverage mechanics.
Okay, break that down for us.
So ETF inflows are passive. They are driven by older, wealthier allocators making long-term portfolio decisions.
Right, they're not day trading.
Exactly. Those flows provide a strong macro floor, but they do not override the active panic or euphoria of short-term traders in the immediate hours after a Fed announcement.
Ah, okay, that makes sense.
And right now, the derivatives market is heavily skewed. Perpetual funding rates are persistently negative.
Let's translate that for the audience real quick.
Yeah.
A negative perpetual funding rate means traders are literally paying a premium to keep their bets open that Bitcoin's price will drop.
Spot on. The market is leaning heavily short. But this creates the concept of a coiled spring. If those passive ETF inflows hold the price up and Powell doesn't deliver a devastatingly hawkish shock today, all those short sellers are going to be trapped.
Oh, wow.
Yeah, they will be forced to buy back in to cover their losing positions. That is the classic short squeeze.
So that coiled spring could easily snap Bitcoin right through the $80,000 barrier.
Exactly. So the battle for 80,000 won't be decided by Bitcoin's internal fundamentals today. It is almost entirely dependent on how the market interprets Powell's tone.
So TradFi expectations hold Bitcoin hostage.
Pretty much.
But while the market king waits on the Fed, the altcoin market is desperately trying to manufacture its own catalysts. And all eyes are on two entirely different locations.
Vegas and D.C.
Yep. A conference stage in Las Vegas and the halls of the U.S. Senate. We are looking closely at XRP right now.
Yeah, the asset is sliding as we head into the massive XRP Las Vegas conference opening tomorrow, April 30th. It is currently sitting at $1.38.
History is acting like a heavy anchor here, too. I mean, XRP has an incredibly consistent pattern of fading conference hype.
We've seen it over and over.
We saw it with the swell conferences in 2023, 2024, and 2025. They rally into the event and then sell the news.
Right.
Even earlier this month in Tokyo, Ripple ran a live demo, settling yen-to-dollar transactions in under 4 seconds, using XRP with major banks like Mitsubishi UFJ.
Which is huge news.
It's the literal use case XRP was built for. And what happened? The price bumped to 138 and then just faded right back down.
Yeah.
I always compare these crypto conferences to blockbuster movie trailers. They show you all the best, most explosive scenes in a tight 2-minute clip. And then when you actually sit down for the real thing, it feels like a letdown. Are we just setting up for another trailer in Vegas?
The movie trailer analogy is highly accurate for how retail money reacts, but the conditions going into this Vegas conference are structurally different from previous years.
How so?
Usually, these conferences happen during a broader market euphoria, so the specific XRP news gets drowned out or the asset is already overbought.
Okay, that makes sense.
This time, XRP is sliding into the event, and more importantly, the on-chain data shows a massive divergence between what retail is saying and what whales are doing.
Right. Our auto-curated feeds flagged that over 7 billion XRP were pulled off exchanges in February.
Yeah.
And the number of wallets holding between 1,000 and 100,000 XRP just hit a record 1.1 million.
It's a quiet accumulation.
At the same time, sentiment data shows market sentiment is deep in FUD territory, fear, uncertainty, and doubt.
And in markets, FUD is often a contrarian indicator.
Oh.
When retail sentiment drops this low while large holders are quietly accumulating, it often precedes a violent upward reversal.
Interesting.
But a reversal requires a spark. It needs a dovish FOMC outcome, or Bitcoin reclaiming 80,000 to drag the broader market up, or it needs a major Ripple announcement on stage in Vegas that actually utilizes the XRP token.
And that right there is the million-dollar question. I had to challenge the premise of XRP's utility going forward. Is Ripple's own stablecoin, RLUSD, cannibalizing the actual use case of the XRP token?
That is the big fear.
Because look at the recent mega deals. Convera's $190 billion processing partnership, it's the integration with Deutsche. They all utilized the RLUSD stablecoin to settle, not XRP.
Right.
If banks just want to use a dollar-pegged stablecoin on Ripple's rails, why hold the volatile XRP token?
That is the most critical distinction in the entire ecosystem right now. It's the utility of the network versus the utility of the native token. You are hitting on the core anxiety of XRP holders.
It seems pretty justified.
It is. The counter-argument from Ripple is that as the sheer volume of stablecoin transactions on the ledger scales into the trillions, XRP is required as the bridge asset for cross-currency liquidity and to pay network fees.
Okay, I see.
But to your point, the true bridge between traditional finance and crypto isn't going to be built by a hype event in Las Vegas. It's about regulatory clarity.
Which brings us to the Senate Banking Committee. They are targeting early May to mark up the Clarity Act.
The stakes for getting that regulation right are immense.
Yeah, JP Morgan just released a report estimating that the tokenization market, which is the process of bringing traditional assets like real estate, stocks, and bonds onto the blockchain to settle instantly, could hit anywhere from $2 trillion to $10 trillion by 2030.
That's massive.
And they are explicitly warning that if the U.S. delays this regulatory framework, all that technological development will just move offshore.
The macro picture for TradFi tokenization is moving forward relentlessly. When you tokenize a real-world asset, you remove counterparty risk and reduce settlement times from days to milliseconds.
It's a game changer.
The SEC, NYSE, NASDAQ, they're all quietly preparing the plumbing for this reality. Whether XRP captures a significant slice of that $10 trillion pie depends heavily on Washington's timeline, not just what happens on stage in Vegas.
Okay, so traditional finance is fighting regulators to tokenize money. But now we need to transition to Oakland, where tech billionaires are fighting over who gets to govern the intelligence that will eventually manage that money.
This is a huge story.
Because today, the federal trial between Elon Musk and Sam Altman officially begins.
Overseen by Judge Yvonne Gonzalez Rogers. This is a monumental case for the tech sector. Musk is suing OpenAI, Sam Altman, Greg Brockman, and Microsoft for what his legal team is calling wrongful gains.
The core of Musk's claim is fascinating when you look at the corporate governance labyrinth.
This is very complex.
He is arguing that OpenAI illegally shifted from its original 2015 nonprofit mission. That mission was explicitly to develop AI for the benefit of humanity as an open-source project.
Right.
But they pivoted into a capped for-profit model, effectively locking up the intellectual property behind closed doors to maximize profits for their primary backer, Microsoft.
Yeah.
Musk wants billions of dollars returned to fund the nonprofit arm, and he wants Altman ousted.
On the defense side, OpenAI's legal strategy essentially boils down to portraying Musk as a disgruntled former partner motivated by jealousy and regret.
They're going right at him.
Oh, absolutely. They argue that after he walked away from the company in 2018, having failed to take absolute control of the board, he watched them succeed and is now using the legal system to derail a key competitor in the race to AGI, or artificial general intelligence.
Just impartially looking at it, let's look at the sheer irony here.
Okay.
Musk is positioning himself in federal court as this unbiased protector of open-source nonprofit AI. He claims AI is too dangerous to be controlled by a single corporate entity.
Right.
Yet he simultaneously runs his own massive closed-source AI company, xAI, which builds the Grok chatbot. And xAI was literally just acquired by his own rocket company, SpaceX, which is preparing for a massive IPO.
It is a bit of a contradiction.
He's complaining about corporate monopolies on AI while building his own corporate monopolies on AI.
The hypocrisy is certainly part of the spectacle, but the legal stakes transcend the personalities involved. We are talking about establishing
The judge has already had to set some ground rules to keep the circus in check. She ruled that Musk's use of RhinoCat, which is apparently Silicon Valley parlance for certain recreational substances, cannot be mentioned in court.
It's a tabloid dream.
It really is, but a tabloid dream with world-altering consequences. And this trial is kicking off just as Meta is looming with its own earnings report, where Wall Street analysts are aggressively asking a very simple question.
Right. Can these companies actually monetize AI beyond just slightly improving algorithms for consumer ads?
Exactly. That is the existential test for the entire sector. Hundreds of billions of dollars are being poured into the hardware infrastructure, the NVIDIA chips, the data centers.
Yeah, the CapEx is unbelievable.
But the viable standalone business models that generate real revenue from AI tools are still largely unproven to the broader market. The trial in Oakland is fighting over the rights to a gold mine, but Wall Street is starting to ask if there is actually any gold down there.
Well, speaking of standalone business models and bringing things back down to earth for a second.
Please do.
While billionaires are fighting over the future of artificial superintelligence and central bankers are wrestling with the fallout of $115 oil in the Strait of Hormuz, the real anchor of the global economy just gave us a surprisingly positive signal.
You're referring to Starbucks?
Yep. They reported a sharp, unexpected rebound in sales for the quarter ending in March.
Yes. The stock jumped more than 5% in after-hours trading.
It's a solid beat.
And they are crediting this turnaround to a few operational tweaks, faster service times, a revamped loyalty program, and some trendy menu changes featuring items like U macchiatos.
The U macchiato saves the day.
It's fascinating. We track all this high-level macro anxiety over war, sticky core inflation, the fate of AGI. But maybe the ultimate economic indicator today is that people are still completely willing to line up and spend $8 on a new macchiato.
It is a perfect example of the lipstick effect.
Oh, right.
Yeah. During periods of high inflation or economic uncertainty, consumers might give up massive luxuries like they cancel the European vacation or hold off on buying a new car.
Sure.
But they substitute those big expenses with small daily indulgences. It provides a localized bright spot in a very heavy news week, reminding us that consumer resilience often defies the broader macroeconomic gloom.
They need their coffee.
People still find a way to engage in their daily routines, even when the global indices are flashing warning signs all over the place.
It's a great perspective, and it really encapsulates the chaotic energy of the day. So, to wrap up our highlights of the day, we have structural supply chain shifts keeping oil prices sky high and inflation embedded.
Check.
We have Jerome Powell stepping up to the microphone to dictate the financial terms of the next year. Bitcoin is wound up like a coiled spring at 80,000, waiting to see how Powell's tone forces the hand of short sellers.
Yep.
And the trial that could literally dictate the commercial roadmap for artificial intelligence has just opened its doors in Oakland.
It is a day of profound structural shifts. And it leaves us with a critical thought to ponder, kind of pulling these threads together.
What's that?
We discussed JP Morgan's estimate that traditional finance will digitize up to $10 trillion in real-world assets by 2030.
Right.
And we are simultaneously watching a trial that could determine who successfully reaches AGI in that very same time frame.
Oh, wow.
So looking ahead, who will actually wield the power in the next decade? The traditional institutions that control the programmable money, or the tech giants that control the artificial intelligence managing it?
Wow. That is a question to keep you up at night, and it's going to come out right in front of us. Thank you for tuning in to the highlights of the day. Remember, NovaStream streams 24/7. Keep your eyes on the live charts right here on the channel as Powell takes the microphone and those Oakland courtroom doors open. We will see you.